Okay, so we have some big news today. The Bank of Canada has reduced interest rates by another 25 basis points. A lot of people were expecting this, so this has really been baked into the cake. But we now are sitting at an overnight lending rate of 4.25 basis points. Now, this is interesting because it's the third rate cut in a row, and the last time the Bank of Canada did this, we already had 3 rate cuts in a row. It was right on the verge of the pandemic. And then the last time before that was on the edge of the financial crisis. So what does this all mean? Today we have none other than friend of the pod, Jason Friesen, mortgage agent and managing partner at Outline Financial, here yet again on another Bank of Canada announcement to join us and help us break it down. Jason, great to have you here.
Thanks for having me again, Ralph. Always a pleasure to hop on the pod. It's been a busy day. I've been fielding lots and lots and lots of phone calls from people wondering how these rate cuts impact their mortgage. I think the big misconception is that it automatically adjusts fixed rates by the same quarter point that the Bank of Canada cut. It's important to understand that when you see the Bank of Canada cut rates, the overnight rate and the prime rate directly impact variable rates, lines of credit, things like that. But for the most part, fixed rates have already priced in this cut. So, not much movement on fixed rates today. There's a possibility that they may go down over the course of the next couple of weeks, but there's always this misconception that a quarter point rate cut from the Bank of Canada means a quarter point cut on fixed rates. And that's not really the case.
And where are we right now with fixed rates?
So right now, I would say for kind of medium and long-term fix, so anything 3 years or longer, they're firmly in the fours, and that's great. If we look back at the start of the year, just taking a 3-year fix, for example, there was a point in time where I think it was 6.5%, and say we're looking at a 3-year fixed at 4.89, 4.79 as of today, in some cases lower, but a significant reduction. People will obviously have much lower payments based on the same mortgage amount. And then it also will help if someone's looking to qualify for a higher mortgage just based on the fact that interest rates are lower. You take like a $750,000 mortgage, and at 6.5%, monthly payment was about $4,700 a month. Now it's down to like $3,950. It's a pretty significant reduction in carrying costs. And I know everyone's been feeling the pinch with these higher interest rates, so this is definitely welcome to borrowers across the board.
Yeah, and I think this one's really important because the first 2 rate reductions were really symbolic. They were symbolic, signifying the end of the tightening environment and showing that, we're at a point now where rates are going to start to come down. But now we're moving into an era of significance, because once you start to get to 75 and 100 basis points, hopefully in October, that will really start to impact affordability and probably sentiment behind that. So it's really interesting right now with the Bank of Canada announcement. Basically, they said that they're expecting inflation to continue to ease. And if that does continue to happen, which is what we're expecting, we can look forward to further rate cuts into the future. And there definitely has been a tone shift out of the Bank of Canada today, and even in some of the more recent statements that are downplaying concerns that it won't hit its mandated 2%. And they're more starting to be focused on the deterioration in the labor market. A little less worried about inflation, and now they're starting to get a little bit more worried about the labor market. And that's really, really interesting paradigm as we're starting to see the shift of a worry of possible soft landing versus inflation. Jason, what do you think about that?
I heard the words hard landing today. So I think they're definitely mindful of the impact or the current state of the economy, and looking forward to where things potentially may continue to go. I was reading something from BMO yesterday. They released it before the most recent announcement. Douglas Porter, the chief economist there, I find that he's not too bullish, not too bearish, right in the middle of the road. I think he's usually spot on with his forecasting and commentary. And the expectation is that we could see a run on another 1.25% in cuts in a row. Every announcement between now and kind of the spring, seeing another quarter point cut. So potentially bringing the overnight rate to like 3%, prime at 5.2%. So it's currently prime is at 6.45%. So that's a pretty significant reduction. And I think if the economy does continue to slow, they left the door open that we can see rates go lower from there. But I think the market has always performed well with interest rates in the threes and fours. And so I think just getting away from these rates in the sixes or even in kind of the mid fives if you're taking a variable rate today and putting those variable rates firmly in the fours and maybe fixed rates hitting in the threes. I think it's really healthy for kind of the economy and the real estate market. And again, it's been proven year after year that rates in that range, definitely the market seems to work fine. What you're seeing right now is with interest rates being so high, and obviously they've come down, but they're still quite high. Affordability is still a big challenge for people. People are not comfortable with the monthly expenses. When you look at a monthly payment, even if they qualify for it on $1 million mortgage, an $800,000 mortgage, it just doesn't work into the budgets of a lot of people right now. So seeing those reductions will obviously change that for the better.
And I think the other paradigm to this is the word uncertainty. So even as rates come down and we start to see better or more affordability in the market, the other issue that we're facing is just uncertainty about jobs, uncertainty about the economy, uncertainty about what's happening in the United States right now with their upcoming election. And so it's kind of weighing those two, but it's just so interesting to see the narrative out of the Bank of Canada shift now from worries of inflation to worries of inflation being too weak potentially and the economy slowing too much. And I find it really interesting if you look at in unemployment, yes, we're at 6.4%, but when you really start to dig at the numbers, you'll see that we lost 42,000 positions, private positions, but that was balanced by the government civil service adding about 40,000 positions, which is not really ideal and sign of a healthy economy. So there's a lot of measures that are making you wonder whether that 6.4% unemployment is true. And if you look at the United States, they just revised their unemployment by close to 1 million. It was like 820,000. How you missed that? 820,000 jobs over the course of a year. So, and that's the other part to this whole conversation is understanding what's happening in the US economy and the Fed. It's starting to look like the US is a lot weaker. Their economy is a lot weaker than we had thought and people were talking about back in the summer. And, I was talking about how the US economy is not just Nvidia stock, but now Nvidia stock is down, I don't know, $250 billion or something today.
Well, I think if you're looking at it, we've got September 18th, which is the next Fed interest rate announcement south of the border. And I think it's looking more likely that they probably will move to cut. There's been even calls for a 50 basis point cut, versus 25, which is a far cry from a few months ago. There was talk that we might not see a single cut in 2024, and pushing it out to 2025 before we saw a cut. So I think if we do see the Fed in the U.S. cut rates, it'll probably open the door for the Bank of Canada to be a bit more aggressive as well. I think we're in a spot right now where if we're looking at this, the U.S. economy almost it seems like it fell off a cliff quickly. It went from chugging along to not chugging along pretty quickly. So we could see the Fed in the U.S. move aggressively, and I think then we could see the Bank of Canada move aggressively along with it. We're definitely more measured in our cuts without the Fed moving, but if they are going to start slashing rates, I think we'll probably see this side of the border be a bit more aggressive as well.
It's interesting because just in the summer, you're hearing everyone talking about higher for longer.
Yeah, yeah.
I haven't heard anybody say that in the last few weeks for sure. And when you look what's happening in the U.S. right now, I mean, it's so interesting when you had that flash crash in the stock market because of the Japanese carry trade that was going on. I saw some pundits and some economists talking about a flash 75 basis point reduction in order to adjust to that, had that crash prolonged longer than a couple days. So it's really interesting to see this dramatic shift in narrative. And apparently, both Canada and especially the US economies were not as strong as people were pontificating yet a couple months ago. So it's interesting to see that change so quickly. And I think here in Canada, given that we have the majority of our mortgages are less than 5 years, where in the States, they go as far out as 30 years, they have a much greater ability, especially from the consumer lens, to hold on to higher rates for much longer than we can here, where we're much more sensitive to those type of shocks to the system. And so the pressure that gets built up when the Fed is holding tight, as you were talking about, it's really, really tough because it presents a lot of pressure on the loonie. And if our loonie falls too much relative to the US dollar, that becomes inflationary on its own. And so the Bank of Canada has been treading a very thin rope here. But if we do see those reductions or a significant or even just a symbolic reduction out of the US, that will give a lot more runway to the Bank of Canada to continue to reduce rates. And from what I understand, most economists are saying that we can have a spread of about 75 basis points from the US to Canada before it really starts to affect the loonie. And so we're at that 75 basis point mark. And we all are aware that all of the banks are talking amongst themselves and they seem to be moving in unison. So I would guess that we can expect to see at least 25 basis points. But 50 probably at this point out of the Fed right now is not off the table.
I'm really curious to see how just this most recent cut from the Bank of Canada impacts the psyche of buyers that are out there looking right now. If it does move people off the sidelines, I think at your point about the uncertainty, I think people that have been in the market, we obviously witnessed two cuts. It's great, but there still was, everyone was proceeding with caution. So we'll see, and hopefully people continue to proceed with caution, but, it may move some people off the sidelines that were unsure about where things were headed. If we do see, the Fed cut, we just witnessed a cut. We're probably in Canada going to see another one in October, another one in December. I'm curious to see how it shapes up this fall market. I think if you're a client right now that doesn't have a condo to sell and you're looking to get into the market, I think there's some good opportunities right now for people to get in potentially before we see rates continue to drop, and then the chaos that sometimes ensues in the Toronto market when rates are low and there's lots of activity. So provided the affordability is there and you really are drilled down on your budget and you're in a good spot financially, and again you don't have a place to sell, I think right now probably presents a pretty solid time to buy that may not be there if we fast forward 6 months from now or 12 months from now.
And what are you seeing right now with your business? Are you getting a lot of phone calls? Are you seeing a lot of
Yeah,
activity with people looking for pre-approvals, with transactions going through?
both. Traditionally August is a slower time of the year, but I've had lots of clients that have moved off the sidelines. I've noticed more clients that are, reaching out and buying right away. Sometimes the cycle might be you work with a client for 12 months. I mean, on your side, sometimes it takes 2 years to find someone a home. They bid on multiple houses, they're unsure. But I think buyers are more decisive when they're moving forward on something. They're like, okay, we want to get pre-approved. We want to move forward. Like, 3 days later, they're saying, okay, we're thinking about making an offer on places. So I think some people are looking at it right now with, a bit of we'll call it a weird market, because that seems to be the only way that describes this market, as an opportunity to potentially beat the rush that could potentially come as we see rates continue to go down.
Are you seeing that sentiment shift happening? Like what is talk to me about tone?
Yeah. So I would say that clients are definitely, they would reach out, they would poke around. As I said, maybe it takes them a month to fill out the application after you send it to them and follow up. Now it's like you send them the application, the way that our application system works, they get a notification when they start to apply. it might be within the hour that people are already starting to, it's a much faster turnaround time I've noticed. And, I think we've also had a lot of clients, obviously, on your side, you transact in purchases and sales, but we also handle refinances and renewals. So that's also a big part of our business. I've had a lot of clients reach out, they're at, 2.5%. Their mortgage is up for renewal. I think there's a misconception that your payment doubles if your rate doubles, and it doesn't. It definitely goes up. And, it obviously increases the monthly payment, significantly, but it doesn't automatically double your payment. So I've had a lot of clients that we've hopped on a phone call, ran through where numbers might be, a couple months from now when they're up for renewal. And the payments, while they have increased, are still manageable and in their budget. So I don't think, I know that there's, a lot of, kind of doomsday sayers out there that are the market's going to crash when your mortgages are up for renewal. Two parts to that. One, if you look at where stress test rates have been, stress test rates, at their lowest were like 4.79. For a long period of time, they were 5.25%, meaning that anyone that bought and got a rate of 1 or 2% still qualified at a higher interest rate. I think the stress test did its job. That's the consideration. So I don't think, there's going to be this giant crash. Obviously, people will have to change, their lifestyle and be a little bit more cautious with their budget with higher interest rates. But people have qualified at these higher interest rates. And again, payments have gone up. It's not ideal, but for most people, it still seems manageable. In the last couple of months, I don't think I've had a phone call with someone that has looked at where their new payments are and say, I need to sell. That's not been the conversation. It's happening, I'm sure, out there. It's not something that I've been, running across with my clients. Part of that also is that I always suggest in any market that you try to be a bit more conservative in your budgeting and never push yourself to the absolute max. Do people always listen to that? Absolutely not. But, I always like to work backwards from a budget with clients to make sure it fits into their financial plan, thinking about, family dynamics. What happens if you have a child? You have daycare costs, any potential changes going back to school, things like that. So I try to, kind of encompass all of those potential changes to income down the road in the consultation. So for the most part, I would say clients are feeling, like they're still going to be able to maintain their mortgages and not have to sell. I think that's the worst thing that we could have happen is have someone have to sell, not at their own kind of pace, but due to pressure, due to higher interest rates.
We're not seeing that at all. We're seeing some people who are a little bit stressed, a little bit trying to navigate their way through uncertainty. But most people we're advising atypical from the stereotype of most realtors is to hold on because we believe far better times in terms of market appreciation are going to happen. Hard to say when, but if you look at just basic supply and demand fundamentals, in a few years, certainly, but maybe even less, we'll see a big rebound on the condo side, and houses and low rise will probably happen sooner rather than later, maybe even by end of year, depending upon where we land with rates and the economy and everything else. So, yeah, and it's just so interesting, talking on this forum and then seeing the comments, how badly people want to see this market crash. And I've been seeing that for over 20 years now. And, I would just say never underestimate the strength of this market and the fundamentals that are backing it up. And if you own real estate in Toronto, hold on to it. Hold. And so, in terms of what you're thinking for the fall, Jason, what are you seeing? What are your predictions, both from a rate? Where will we be by, let's say, end of December, and where are you seeing the market?
Sure. Again, I think the one tough spot for the market is, in the real estate market where I'm seeing clients that are struggling, that even potentially want to make a move, but their equity is tied up in their property. Is that like one bedroom condo if they have to sell that? I think that's the one kind of area right now. And I think part of that is, when you look back to, the last, call it 2019, 2020, even into 2021, you had people that bought condos and, you buy an investment, you have to put 20% down. That's just the requirement. But a lot of investors didn't put 20% down from savings or cashing in investments. They took it from a home equity line of credit or a HELOC against their house. And there was a point in time where prime was 2.45, then prime hit 7.2%. Payments almost tripled on those lines of credit. And I think a lot of those investors, I think that's, and I obviously, I'm not sure if that's the case, but from my perception of the market, there's a lot of investors that are selling because of the impact to their cash flow with carrying some of these places now that rates have increased, or maybe they're on a variable rate on the mortgage part of it as well. So seeing rates come down will bring a little bit of relief to people as well. If you don't need to sell a condo, obviously I'm not a realtor, but if you don't need to sell your condo right now, if you can hang off, that would be, from my perspective. I do think if we fast forward a couple of years from now, we're probably going to see a shortage of condos, just based on the fact that it doesn't seem like a ton of new construction is happening right now.
It's projected by 2028 there'll be 5,000 new condos coming online in the GTA.
Wow.
Yeah.
And what's the average per year, like over the last 5 years?
I'm going to say like 20, 25.
Yeah. And population growth continuing, maybe not at the same pace, but
we need, I think the strongest years we got about 40. We need at least 40 per year.
Wow.
Conservatively. New homes.
Wow. And there's going to be 5 if we fast forward 4 years from now. So can you hang on? Can you make it work for the next, 4 years if there is a way to do so? I assume that's your advice to people that don't need to sell, is just hang on.
Of course.
Yeah.
Of course. And, okay. So you still haven't answered the questions, Jason. Where do you see the fixed and the variable by end of year?
By end of year, we've got 2 more Bank of Canada announcements. So that would push prime from 6.45 to 5.95 if we see 2 quarter point cuts. Variable rates, would start touching into the 4s, which is great. I would say fixed rates in the low 4s, maybe into mid next year, starting to see, kind of medium and long-term fixed rates touching into the 3s would be ideal. Maybe even into the high 3s. That would be ideal.
And are you thinking hard landing, soft landing, no landing?
I would like to say a soft landing, but who knows? Things could get ugly.
Okay. And where do you see the market?
Hopefully up by the end of the year. Hopefully we see a bit more activity as well. I think it seems like there's a glut of condos right now. I think that needs to, need to start seeing inventory start to decrease on the condo side. But there probably is a bit more pain before things get better on the condo side. Seems like, from my perspective, there's a tale of 2 markets. I don't think it's, it seems like there's single family and there's condo right now. I don't think it's 2021 when things are selling 400K over asking, but for the most part, it seems like, detached and semi-detached have been holding their value quite well. And I expect as rates go down, we'll probably see a little bit of upward pressure on single family to end the year and moving into 2025.
Yeah, I think you'll see that low rise, semi-detached and detached will be the first to take off. Whether that happens this year or next spring, relative to where we land with interest rates, because just there is such tight supply. When you get that little blip in demand, that will be the first segment of the market to take off. And once that pushes that gap, there's a traditional gap between low rise and condos. And once that gap becomes very excessive, which we've seen before, as low rise takes off, which will be the first leg, the second leg will be the condo market. And then the third leg will be pre-construction. So, and I don't think we'll see pre-construction for at least another year, possibly 2 years before it even starts to rebound. Condo market could be a year from now. And going back to where I see interest rates, I think we're going to see the Bank of Canada rate at about 2.5% a year from now. I think I've always been I've been very much against the higher for longer narrative, and I think things are much worse than they're telling us or letting on. I don't trust the data. It's all lagging data, and it's always being revised downward. So I'm a bit suspicious, and I do think that we will be in a position, both the Fed and the Bank of Canada, where they will excessively start to reduce rates. But the good thing is in reaction to where the economy is, they do have a long way to go until we start to balance things out.
If you're looking to get into the market, I think you just really need to be drilled down on your numbers. That's really what it comes down to, is just make sure that you work through a budget and you really stick to it. I don't think now is the time to put yourself in a bad spot. But with that being said, as I mentioned earlier, I think there potentially might be some opportunities that exist that may not if you look into kind of the spring market next year.
Well said. Jason, thank you so much for joining us. Where can people find you?
Outline.ca is my website. You can reach me through there, or jason.friesen@outline.ca. Shoot me a note. I'm always here to help.
Awesome. Jason, thank you so much for joining us. And to our viewers, thank you so much for watching the Toronto Real Estate Podcast, talking about the latest Bank of Canada announcement. If you like our content, then be sure to click that like button. And definitely subscribe so you can stay in touch with us in terms of what's happening in the market, boots on the ground. And if you have any comments, please be sure to comment down below. We'd love to hear from you, as long as it's constructive. Doesn't have to be positive, but definitely has to be constructive. Thank you all so much for joining us, and we hope to see you next week.
Thanks, everyone.